What if I told you it is absolutely possible to generate £40,000 of tax-free income in retirement per year? So in this video, I'm going to show you exactly how to use our tax system effectively and generate that tax-free income. Now, I have to say, in reality, it's unlikely to be practical to have all the different wrappers that I use that will perfectly align in my example. That's not the point. The point is to show you what's possible so you can consider this with your own planning and organising your retirement strategy. Okay, so the first thing I need to do is I need to recap how our tax system works. And the best way to do this is via a bucket analogy. And we're going to imagine that your income is water filling up this bucket. Now, as you go up the bucket, there's also some little holes in them. And these holes get bigger the higher you go up in the bucket. And this is like the tax position because it's progressive. So basically, the more you pay in tax, the more you earn, generally, with some Cayman Islandy exceptions. But we're not going to go into that. Anyway, because UK income tax is tiered, we only pay a specific rate of tax on the amount that falls into a particular band. Now, whatever happens is that when the water comes in to a certain level, it'll go up in tiers, despite the fact there are little holes in it. However, those holes in the bucket will get bigger the higher you get up, and that's basically to symbolise more tax coming out. And each tax year, it stops and restarts. Okay, I think I needed to do that. It's very, very high level, but it's just showing you briefly how it works. There is, however, something missing from that analogy. And that is that there are specific tax rates and allowances that not everyone knows about, which allows us to potentially take advantage of what we can receive in retirement. So now I need to tell you about different sources of incomes and how they can have different tax allowances. And this is the secret that I'm going to unpack, which is how we build the strategy to take advantage of this. I do have to say this is all for England and Wales, so Scotland has a different system, so please bear that in mind if you're in Scotland. So the first thing is the personal allowance, which is £12,570 for this tax year, as long as your adjusted net income is below 100 grand. We're assuming that you're going to have no other income in this example because you've retired and this isn't a problem, so you do have your full personal allowance. We're also going to assume that you've got some flexible pensions. Now, the flexible pension, we're going to say, gives you the option to cater your withdrawals. So the first thing you're going to do is you're going to draw down a taxable pension withdrawal that's going to be specifically £12,570. Now, this comes with 25% tax-free cash. So on top of that is a 25% tax-free cash payment, and now we're at £16,760. So that's £4,190, which is specifically pension tax-free cash. So it's not actually counted as earned income, hence the tax-free. Okay, so we're still a long way from 40 grand, aren't we? Well, you've also used all your personal allowance. So what next? Well, rates on cash are rising, and if income is below 17,500, there is what's called the starting savings rate. Now, any taxable savings income that falls in the first £5,000 of basic rate band as an individual won't be liable to pay any tax on it, as it's the starting rate savings for income is 0%. Now, this doesn't just cover normal standard deposit cash accounts. It also actually covers interest-producing open-ended investment companies, or OICs, and also some chargeable gains on insurance bonds, but we're going to park that entirely. So I'm going to say you're able to use this starting savings rate, and now we've generated even more income which has come through tax-free. Okay, still some way off. Next on the list. Capital gains. Okay, so the recent budget did not help at all with this. However, if you do happen to have any investments outside an ISA, there is the capital gains tax annual exempt amount, which is £6 grand for this year. And that's basically a gain on any investment outside of a tax advantage environment like an ISA or a pension. So what we're going to say is you're going to encash part of your gain, and that's going to realise £6,000 of tax-free income because you're going to use your capital gains tax annual exemption. So the total now, based on all the different things we've got the personal allowance, came through tax-free, the starting rate on savings, the tax-free cash from the pension, and the capital gain. And I should also say that if you go above that capital gains tax exemption amount, it's 10% for any gains that fall within the basic rate, or 20% for any gains thereafter. There is, however, an exception if it is anything to do with residential properties that don't carry private residence relief, so like buy-to-lets, and they've actually got a rate of 18% for everything in basic rate, or 28% in anything in above that. But on top of that, we've also got the personal savings allowance. So the personal savings allowance allows tax-free savings of up to £1,000 for basic rate taxpayers, £500 for high rate, but none for any additional rate, sorry. And that can be used on top of someone who has a starting rate savings band. So next is the dividend allowance. And basically the first £1,000 of dividend allowance is taxed at 0%, regardless of how much income you earn. So we're going to say you've got exactly £1,000 of dividends. And so we are going to assume you can perfectly control your dividend distribution here, but give me a break. So now if we add all that together, we're at £29,760. So where's the rest? Where's the rest coming from to get to your 40,000? Because that is what I lured you in to watch this video. Well, before I go into that, I have a special offer for all the good people who watch my channel. Exclusive to you is how to avoid expensive retirement mistakes in my free ebook, 5 pension tax mistakes to avoid, showing you the most common tax mistakes, how to avoid them. But you don't just get that, you also get a 5-day email sequence which will tell you about the science behind living great retirement, what your most valuable asset is, and also you'll get access to my only available to newsletter subscribers life-changing retirement masterclass, where I show you step by step the secrets of how I plan for my clients. You'll also be part of my mailers, get exclusive access to updates as they come in on things like the budget and the secrets from an industry insider. So how do we get to the rest, to the 40,000? Well, look, we could take out additional chunks of tax-free cash on the pension as long as our provider allowed it, if we're chasing the income. So with a money purchase pension, you can take up to 25% of the pot of tax-free cash. And the maximum you can take, if you don't have lifetime allowance protections, is currently $268,275. So theoretically, if you're fortunate enough to have a big enough pot, there is quite a lot of income that you could potentially draw just by taking your tax-free cash entitlement. Now, of course, that will eventually exhaust, but the next option is maybe to use ISAs. And obviously ISAs are tax-free on extracting funds, apart from the exception of the lifetime ISA, which has to be used as a first home under 450 grand or after 60. But apart from that, one of the many strategies that I run for my clients is looking at options such as maybe spending down the ISA as part of a retirement income strategy. So you could absolutely use this in line with the other strategies to generate income. You may also have an investment bond, oh God, which means you can extract 5% of the initial investment without tax, or to be precise, tax-deferred withdrawal. Now, investment bonds are complicated. I could do a whole video on them, so I'm going to leave it there, but it is possible. And you may also be aware of things like venture capital trusts, which are, very high-risk investments, but they do offer tax-free dividends. Or perhaps EISs, enterprise investment schemes, which again, tax-free on growth. But just remember, both VCTs and EIS are both high-risk investments and certainly not right for everyone. I'm just mentioning it because someone in the comments will say, why didn't you mention it? And there you go. Welcome to YouTube. And you might also be considering things like equity release, which again is not right for everyone. But equity release is basically a way to access the equity in your home without having to sell it on a tax-free basis. And there are lots of equity release products available, including lifetime mortgages, home reversion plans, all the rest. And these do give the opportunity to generate tax-free retirement income. It's a huge decision though. I'm certainly not advocating it, and it's really important to seek professional financial advice if you are considering it. I think it's the area that I think it could probably become more popular for people going forward is people who have particularly high value homes that also have high estate charges. I could see that being a tactical area of planning going forward. But obviously banks aren't going to do it for free. You're going to pay quite a high interest rate, so it's something to be very careful on. Now, I understand that it's probably not practical for you to have all these different types of wrappers to be able to utilize that to that extent, but hopefully you've come out of this knowing at least a few extra options when you're looking at your retirement income strategies. But you might be wondering, okay, well, it's all well and good knowing how to manage the tax wrappers and all the rest of it, but look, how much is my pension pot going to give me? Well, thankfully I've done the perfect video which is going to help you find out.